Good morning, everybody. Thank you to everyone who's tuned in today. I hope you all had good weekends. Thank you for everyone who dialed into the sessions from last week. As we explained, everything is now available on demand, so you can go back and watch those at your leisure. You can also still register for any of the future sessions as well. The registration is still open on the event website. This morning, and this is a new topic for us at the ILS Asia series of conferences, we're going to be discussing life insurance and securities, specifically what cedants and investors need to know. So this is going to be a bit of an educational session, but I'm glad to be joined by two very experienced participants in the life ILS space from two of the leading firms that run dedicated life funds. We have Tom Spreutels, Head of Origination, Life and Alternative Credit at Leadenhall Capital Partners, and we have Luca Tres, Partner at Securis Investment Partners, LLP. So we wanted to begin introducing life as a topic to this conference, sort of in an educational manner, providing a backgrounder for the audience so that you can understand some of the opportunities available in the life ILS space, both from the cedants and the investor side, the risk transfer it provides, and the benefits of the returns that investors find in adding life ILS to their portfolios as well. So I thought to begin by way of introducing themselves, what I'm going to do is ask our two participants to just sort of introduce themselves, talk about how your career path led you into the life ILS segment in particular. It's interesting because it's a sort of a niche within the ILS space, sometimes it seems. So let's begin with Tom.
Hi, good afternoon, everyone. Good morning for those in Europe. So life ILS is relatively new to me. I'm a banker. I spent 20 plus years in investment banking at Citi and Deutsche Bank. And after that, I thought it was time to do something new. So an opportunity arose within Leadenhall, and after a number of conversations, it became very apparent to me that some of the things that we do in life ILS is not very different to what is being done in finance and banking. And so therefore, I thought this was an interesting new path for me to follow. So in essence, the experience over the last 20 plus years that I've gathered from financing and risk transfer is easily applied here in this field. And it's somewhat different in the sense that you're working directly for investors and you're working much more closely with cedants and financing partners. So, it's all very interesting.
And so from the insurance and reinsurance side, it's a steep learning curve, do you think? Or
the reinsurance bit, yes, but I have lots of colleagues who are very steeped in that field, so they can help me out where required.
Sure. And Luca?
It didn't happen intentionally. It happened just a natural flow. I joined Deutsche Bank in London in 2007, and I was covering international customers in Switzerland from London. So the multinational like Roche, Novartis, etc. And of course, if you cover Switzerland, you bump into banks and insurance companies. You can't escape them. So on the back of the work I did with the likes of Swiss Re, Helvetia, Zurich, etc., I was asked if I want to join a newly created team that was focusing on providing European insurance companies with solutions around their capital, financing, and risk management needs. And I did so, and I'm actually glad I did so because it was shortly before the implementation of Solvency II. Therefore, it was a super interesting and steep learning curve on how Solvency II was going to work. And I need to say that we actually have done extremely interesting transactions back then. The most public one is the 12 billion reserves Aegon longevity swap in 2012. That was a policy release, the largest continental European longevity swap targeted to capital market investors. On the back of that, the opportunity of doing the same from a buy side came up. And I thought, why not? I mean, banking was already having some challenges on the regulatory side, the ability to take insurance risks as a bank. So I thought, why not trying to do this from the buy side? And that's what happened. I joined Securis in 2015. And the idea was pretty simple. I doing the same I was doing in Deutsche Bank. I originating and structuring transactions where, in this case, Securis takes a life or health insurance risk. And the fact that we approach counterparties directly, being also the principal risk taker, makes a massive difference to them, because you don't have an intimidation cost, you don't have any middleman, and it makes the conversation much smoother and much more direct.
Interesting, thank you. So I thought we'd go on and ask you both to explain sort of how your employers target the life sector and your respective strategies for life ILS investment management. And let's carry on with you, Luca.
So the focus of Securis when we discuss opportunities with cedants and, of course, what we promise to investors is a super strong focus on the correlated opportunities. Our investors come to us because they know we have a track record in delivering an attractive return, and a return which is truly decorrelated from fixed income and equities. That means that whenever there's an element of market risk in an opportunity, either we don't do it or we find a way to hedge it, to hedge market risk. It also means, by definition, that we do not get involved in direct equity plays. We do not buy equity insurance companies or insurers of any sort. It also means that we do not do tier 2s or unsecured financing to insurance companies. Everything we do is focused on situations where our payout is linked to a specific performance of an insurance block on the life and health side. The vast majority, without saying probably more than 90% actually, so it's almost the whole thing, is private bilateral transactions. Of course, we have some element of what we call public or semi-public securities, like the Vita, the Vitalities, and similar bonds. But we always thought that the true value from in the market comes from the moment you approach a counterparty directly, you offer them a truly customized offering, and by doing that, you can squeeze out a much higher return for our investors and still make the counterparty very happy because they have something that actually is fit for them. It's something that they find a lot of value in. That has been our focus.
Great, thank you, Luca. And so, Tom, at Leadenhall, is the strategy similar?
It's not dissimilar. I mean, so we try to play across the entire ecosystem of the life insurance industry, and whether that's life or health insurance. And so, as Luca said, there is clearly a space to play where traditional players do not get involved, because we, as specialists, understand the actuarial value of certain streams of business and certain blocks of business. And so, we can provide financing against that, and that's where we can be differentiating compared to traditional providers of financing, and get returns that are more interesting for our investors. It's also important to note that similar to Securis, our investors don't want us to take market risk. Right, we're an alternative investment bucket, and so therefore, given the skill set, given the actuarial focus, attaching to those cash flows, which are really linked to the biometric elements of life insurance, brings value to investors. I think it's also important to emphasize that, of course, we do more than just financing. So there are mortality transactions we get involved in, excess mortality. Most of those are tend to be more privately syndicated transactions. So the spectrum is quite broad, and we try to play across the piece, but we also have to be always focused on getting the right return for our investors, which means that sometimes we end up doing more financing than traditional reinsurance business because there is less capacity in that space than there is in the sort of traditional life reinsurance space, and so therefore getting those enhanced returns may be a little more challenging.
Great, thank you. So just a reminder for everybody who's watching that you can submit your questions through this session. Please use the Q&A box that you'll see on the screens in front of you, and please feel free to submit any questions you like. Take advantage of having two experts in the space in front of you. So I thought we'd move on and just discuss sort of our way through some of the different structures and styles of transactions that you enter into. And perhaps we could carry on with the extreme mortality, which you just mentioned, Tom, as this is clearly the area of the life ILS space that I suppose is best known at this stage, given the sort of the use of catastrophe bond structures for those transactions. But it's also a private market as well, isn't it? So perhaps you could talk us through a little bit more about that space.
Yes, I mean, so there are some well-known public transactions in there where we try to play, because that is clearly what the origins of the firm and what the origins of life ILS were. But the risk reward needs to be right for us to play. Of course, there are also a number of private transactions which we aim to get involved in. And frankly, if we think about what is going on right now, I think there could be an interesting opportunity out there to provide excess or cat mortality at attractive rates, because well, there is capacity. Investors hopefully would want to get exposure to that, and we can hopefully identify areas where we get rewarded for taking that risk. But unfortunately, it's an area where there hasn't been as much supply as perhaps we would have liked to see, and I think it's one of the points we will be talking about later. But there's a lot of capacity out there, especially from traditional reinsurance firms, and so therefore it always, for life ILS, remains a little less straightforward to get the right exposure to the right type of risk.
Yes, it seems a market that's highly competitive as well. So you've really got to be able to offer solutions that meet clients' needs. Luca, at Securis, the mortality area is a significant piece of the portfolio.
It's an important part, but it's not the only part. I mean, if we look at how we see the market and where we invest money, I would split the universe into two different main categories. The first one is what I call the embedded value and commission financing category, where the key risks are, and only risks actually, are remote mortality and remote lapse risk. The second one, which is maybe less familiar with investor base, but still probably the most innovative area for our industry, is the area of solvency solutions, i.e. situations whereby our structure is highly customized to give our party capital and or rating benefit. In the first case, as I mentioned, I commission financing and by the value. The key risks are remote lapse and remote mortality. They're all private. I mean, I have not seen a public deal on that front in years. It remains our largest investment category by far, but they're all private transactions. On the second one, again, they are all private, and they tend to be less relevant in terms of number of transactions compared to the embedded value category. But it's still for us a very interesting area to focus on, in an area where we have a lot of results for it, frankly. I mean, for example, we closed an innovative longevity deal in December last year, and we did another transaction of a similar nature, although not longevity risk, earlier on. So I would consider both opportunity set extremely relevant for our investor base. Of course, the predominant one is the embedded value commission financing space, where, as I mentioned, investors take extreme mortality and extreme lapse risk.
And do you find that the ILS fund structure and the way you deploy capital is very attractive to cedants looking for that type of financing?
Look, it's a very interesting question you asked, Steve. Because, if we zoom out from our little niche area and look more widely about the insurance or insurance landscape, we are competing with different type of players. We are, of course, competing with the insurance companies globally. We also compete against banks. So in the past, all this embedded value financing opportunity set was mostly dominated by banks. I mean, I mentioned a few deals that we did at Deutsche, and a few of them were actually linked to embedded value financing. Reality is that these days, especially with second-tier, mid-tier insurance companies, there are opportunities for people like us to offer them something competitive. That comes from two different sources. One is the fact that we are an asset manager and regulated as such. The second is our ability, our skills, and our willingness to truly offer them something highly customized. There's an opportunity set out there of counterparties that do not get serviced well by the reinsurance industry and by the banking industry. And they're typically mid-sized insurance companies. Mid-sized insurance companies that are actually growing very fast. That's where our capital, in our opinion, is best deployed. With great counterparties that do not get the right service from banks and from reinsurance companies and can still pay much more than risk implies because of their cost.
Okay, thank you, Luca. Tom, I assume the financing side is a big piece of your work as well. Is that an area that that you'd also done any work on in the banking space prior to your time at Leadenhall?
Yes, absolutely, and it is, and it's one of the reasons why I thought this is an interesting proposition because, frankly, in banks, you have very complex capital and risk models, and I'm not saying we don't have risk models, in our firm, but banks are designed to take risk in certain ways, and they're designed to take very specific risks which are very modelable. And some of the things that we do are different because we take insurance risks, and banks are not really set up to do that. So the capital charters and so on and so forth make it really hard to do transactions. And I've got quite a bit of experience working on transactions where there's always this little at a bank where there is always this little something where you try and get it done and get it through an approval channel. It somehow doesn't quite fit, and you try to make it fit, and that means that banks will find it much more difficult to do some of the things we do. Now, of course, as Luca highlighted, banks tend to focus on the really large players in the sector. We tend to focus more on the middle and smaller players in the sector, and so therefore you can get to do many more interesting transactions, really solving problems, and you don't have that big backdrop of regulatory risk capital, which you would have as a bank in trying to sort of solve for that. Here we're truly focused on solving the solution for the counterparty or the client, because essentially, as long as we can, in a risk-adjusted way, make the right returns for our investors, we can move forward, because the whole framework through which you try and get transactions done is somewhat, I wouldn't say simpler, but more straightforward in terms of navigating that. And so, that is really where I think the ILS sector can differentiate from more traditional capital providers, because A, we're specialized in what we do, and so therefore, for the counterparties and borrowers, we can probably get to a better transaction, and B, because again we're specialists, we're focused, and they also know we're going to get that transaction done, because even if some complex hurdles were to come up, we're specialists in insurance regulation, and insurance opportunities, and so therefore everyone's aligned.
Thank you. And so on the structural side, when you're entering into transactions, is it very similar to the way you see your colleagues entering into transactions on the P&C side? Are you using the same types of vehicles to enter into the transaction and channel that risk into your funds?
I would say not, because I think on the P&C side, the way Leadenhall does business is quite different to what we do on the life side. I mean, financing trades, we issue notes, we invest in notes that are issued by the borrower, or we go into bilateral loan transactions, or sometimes we go into reinsurance treaties, or we use protected cells. I mean, I think that technology of protected cells, of doing retrocession, of like buying into securitized transactions, is much more commonplace in the P&C side.
Mm.
So it's much more bespoke, the way in which we do our transactions.
Right, okay. And Luca, you mentioned a couple of longevity deals that you'd worked on in the past. Now, obviously, this isn't as prevalent a risk in the ILS space because of pension funds already holding significant longevity risks themselves, but there are some investors who do appreciate the returns from that. Is that an area that you work on at Securis?
It is an area we work on at Securis. As you already mentioned, Steve, this is by far not the main area, because a good part of our investor base is pension funds, and of course we respect their will not to include longevity in our investment portfolio. Therefore, in the vast majority of the life investments we do, there's no longevity risk whatsoever, and their main risks are lapse and mortality. Still, there are some specific vehicles that we have that are open to have a wider view across life risks, including longevity. And I mentioned this longevity deal we have done in December 19, a few months ago, because it's an example of what Life ILS can do for the benefit of the wider insurance industry. I mean, yes, at the moment, our business is mostly financing of commission financing and better value financing for mid-size insurance players. But I think we deserve to be recognized for an element of innovation for the whole life insurance and reinsurance industry. And that applies to longevity, but that also applies more widely to other areas. For example, we did a few years ago the first ever LAC DT transaction in Europe. It was very innovative. It was a lot of work done with the regulator, with the counterparty, and it was a mix of different risks behind it, all biometric risks, just to be clear. So there was no element of market risk. And again, that's not the majority of what we do by far. I mean, our core business is and will remain in the near future, at least, the bulk of financial opportunities, as you mentioned. Still, I think investors do appreciate the fact that we find extremely attractive transactions by innovating the space and by looking at areas whereby, because of complexity, because of specific need, because of a specific requirement by the counterparty, we actually able to charge much more to the counterparty to the risk at the benefit of our investors.
Great, thank you, Luca. So I guess one other area that I know is part of the Life ILS universe is health insurance as well, and health-related transactions. Obviously, a lot of people will be familiar with Aetna's Vitality series of health insurance-related transactions, but what other activity do you see in that area of the health space, Tom? Or do you just see that, is that a very similar form of transaction to the other life deals?
Well, they are and they aren't. So, what we try to do is apply some of the things that we know from, working with life companies to health care companies. I mean, you mentioned the Vitality series. Clearly, it's a very well-known opportunity for investors. There are others out there. Commission finance has been mentioned. I mean, that is something where, again, in certain areas we like to play, and because it's something that is highly predictable, highly biometric. Similarly, healthcare insurance, they are insurance companies. They require capital. There is embedded value there. So again, that brings you an opportunity to go and provide financing. And in certain parts of the world, clearly there is a very dynamic entrepreneurial culture around that, and that's where we try to be innovative and identify opportunities. Again, away from traditional financing providers. So it's bringing all of that knowledge and understanding around biometric risks and how to apply financing to that, or how to apply risk transfer to that, to a subsegment of what is ultimately life insurance, but then focus on health.
Okay, so if we shift to the sort of the investor motive for allocating to life ILS funds, such as the ones you guys run, why do you feel investors should look to life ILS? What is it about the space that you think is perhaps unique among alternatives, and why are the returns particularly attractive, do you feel? Let's start with you, Tom.
Because, well, as we've discussed, a lot of what we do at Leadenhall, and I think also at Securis, is private. So therefore, finding these opportunities to, first of all, find attractive returns. That's one reason. Secondly, these returns tend to be uncorrelated to whatever else is going on in the market, right? Because we are financing or securing against life events. And these life events are completely uncorrelated to what's going on in broader markets. Now, okay, certain products, especially when you're talking about commission, may have a degree of element of exposure to the overall cycle of the economy, because, they are potentially discretionary spend, but you can model around that, and you can build that into your stress scenario. So therefore, we should be, and actually the sort of period of volatility in March has shown that, we should be truly uncorrelated to what is going on in markets. And the cash flows which we finance should continue to just perform as expected, because ultimately the risks we're taking are lapse, mortality, morbidity. And if we've modeled that well, then they continue performing. And so therefore, it is a truly alternative, uncorrelated asset class where some interesting returns can be achieved. And there aren't very many people who play in that space. I mean, what we have observed is that, we've talked about it earlier, some mainstream lenders or mainstream investors may dabble in it, but then, they're not really specialists in this field. And so therefore, we still find that there is absolutely enough opportunity and great opportunity for specialists to really continue to focus on that.
Thank you, Tom. Yeah, it's interesting because obviously this is a space where you actually work very hard on origination as well as structuring and allocating your capital to transactions. So there's a significant opportunity to generate alpha for your clients as a result. Luca, give us your view on sort of how do you sell life ILS to a new investor?
I can tell you, Steve, what actually an investor told me recently during a meeting. He told me that he read one day a sentence in a pitch book from a non-ILS player, something that was along the lines of, it is only in less efficient markets that hard work and skills produce a superior return. And that sentence is probably the best summary of what we do. We focus on highly complex opportunities in a clearly not efficient market. And by the fact that we do a lot of work on the origination front to find the right counterparties, by the fact that we do a lot of work around the legal aspect to make sure that we have a secure claim against the counterparty, by the fact that we curve out all the market risks, you truly end up with a very completely uncorrelated return, as well as with what I've defined through alpha, i.e. a transaction that pays not because it's linked to a risky opportunity, but simply because it's linked to a complex situation whereby you get paid for the work you have put in to solve those complexities. And that's where, in my opinion, the core of what we do comes up. I.e., we look at finding a solution for counterparties whereby Solvency II or the local regulatory framework, rating, financing needs, find a common solution. And as everyone knows in the insurance industry, finding that center of those solutions is extremely complicated. And if you actually achieve that common solution, the counterparty is happy to pay up compared to what they would normally do in a vitality or beta situation, because they get something actually worthwhile for them. And on the other side, the investor we have enjoy an alpha type transaction, which is decorrelated, and it pays much more than it should if you look at the risk.
Great, thank you. So in both of your last answers, you both mentioned correlation and the fact that this is a largely uncorrelated asset class. Now, obviously, we're in the middle of a global pandemic, which has obvious health and life market implications. I guess, firstly, were there any concerns when the pandemic broke out for specific mortality-related positions that you held in your portfolios? Let's start with Luca on that.
Yeah, so, as I mentioned in an article actually with you, Steve, if the ILS community manages to come out of the worst pandemic of our life without any substantial loss, I think we pretty much achieved our goal by providing something uncorrelated and resilient for our investors. Yes, of course, there are some situations whereby an element of extreme mortality that can have an impact on investment. But frankly, in all the private transactions we do, the element of mortality is so extreme that we do not expect them to have an issue. So as a whole, I actually see COVID-19 to have a positive impact for our industry, because it translates into better opportunities for us to deploy money, and it translates to opportunities to find even more attractive returns.
Great, thank you, Luca. And Tom, sort of on the same topic around the pandemic, obviously perception of correlation may have changed slightly because of this, but also perception of risk as a whole. And do you expect that this will translate into potentially more deal flow in the life ILS space?
I would hope so. Well, I think what's going on right now, I think we need to bifurcate two things. On the one hand, there is, of course, a pandemic ongoing, and so that's clearly a mortality event. And so, question number one is that mortality event actually eating into any of your investments? And so, that's one topic, and we will see how this all plays out, because it's still ongoing. But initial sort of assessment seems to think that not, because the deals have been structured to much higher triggers. Then secondly, as a result of the ongoing pandemic, we're seeing some very dislocated markets. At least we saw that in March, and we've then seen the risk appetite moving in different directions, which means that we can, especially because we are attaching to mortality, morbidity events command different pricing, because it's clearly it's real to people, both borrowers and investors, that these are real events. They're not just theoretical, hypothetical. They're happening. So on the one hand, because there is less risk appetite from the non-specialist players, which means that that brings an opportunity for us. Secondly, it probably also means that people in the industry who have been affected by the secondary impact, i.e. the market impact, may need to start thinking about doing something, which means attractive opportunities for us to go and play and be part of a solution to a problem that people may be waking up to, that they may be having. So, it's interesting that a pandemic, which is clearly something that we are directly exposed to, because that's what it says on the tin, Life ILS, is creating an opportunity set and is creating sort of market volatility and potential correlation issues completely unrelated to the real risk that we are running. And that's what makes, I think, the sector really interesting, because all of the turmoil we're seeing is not as a result of the mortality, but it's a result of the lockdowns and all of these other things. And then secondary to that, or tertiary to that, that brings an overall new opportunity set around new products and new solutions, right? How well were people prepared for this, and have they really been buying the right kind of covers to deal with pandemics? And that is something we're thinking very hard about.
Great, thank you. So we've actually got quite a few questions coming from the audience, so I thought we might try and cover a few off now. And one of them is, what are the typical sort of return percentages or ranges of margins that you see in Life ILS, and are they superior to property and casualty cat bonds, or just more akin to a fixed income instrument? Let's go to Luca for that one.
So comparing Life ILS to the fixed income opportunity set is not appropriate for the correlation or uncorrelation element we just discussed. But as a whole, I would say that you should expect a net return for investor around LIBOR plus 5 to 6 in dollars when you put together different type of opportunities. Again, that type of return is only achievable if you focus on truly private transactions. If you were to invest in the Vitalities, Vitas, and similar public transactions, you end up with a return around LIBOR plus 200 before any fees, by the way, which is actually why Securis, a long time ago, we made a choice, strategic choice, of moving away from public deals and focusing into highly complicated private opportunities, because you end up with that type of return in the mid to high dollars. They are, as we discussed, true alpha returns. So do I think they are better than P&C returns? It's not for me to decide, it's for investors to decide. They have a completely different type of risk here. And of course, I cannot comment on the P&C side. Do I think they are more beneficial to investors compared to investing in fixed income? Absolutely yes, for two reasons. One is return, i.e. our transaction tend to pay much more compared to a bond because of complexity and because of the way we structure it. Second is the correlation, as you mentioned. So the fact that it pays more and is decorrelated should be an immense element of benefit for investors when they include it in their portfolio.
Great. Thank you, Luca. And Tom, I'll throw this question to you. It's back to thinking about COVID-19 and how that might impact transactions in the space. Will actuarial adjustments be needed in future transactions to account for this? I mean, I assume that will just be factored into your modeling. But as a result of that, is there any changes to the capital security in order to meet relevant solvency rates? Can you see any adjustments being required there going forwards?
I mean, I think we just reflected in our modeling. I think everyone should reflect this in our modeling. This is an event. This means that your experience set is different. So therefore, you're going to look at the future, with the benefit of having that experience. It maybe regulators will require insurance companies to run additional stress tests. But if we look at it as a pure mortality event, whilst it's sad to see the numbers associated with COVID-19, the absolute number is high, but it's not exceptional. So, crudely put, it's a sad event, and it's clearly affecting all of us. But from a pure mortality event, this is not really a big deal, so to speak. And it sounds crude to say it in that way, but so therefore, when we think about future transactions, of course, we will always have this in the backdrop when we think about modeling, but less about the mortality aspect, more about the behavioral aspect that is following this, because I believe that if anything were to be having trouble, it may be because people can't do certain things, like certain payments can't be made, or people can't go and buy something face to face, which they were buying face to face in the past, rather than there being some problems with real excess death rates.
Thanks, Tom. And Luca, back to you for this next question. Most of the transactions appear largely bilateral in nature, but is there a secondary market for life ILS? And how could you make the asset class more liquid, do you feel? Or do you want it to be liquid, I guess, is another point as well.
A very fair point, actually, Steve. So are there secondary opportunities in the life ILS space? Absolutely, yes. Both for public bonds by definition, but also for private transaction. We have, for example, seen a private commercial financing deal being traded in the secondary market a few months ago, as an example. So also when you see private in the description of a deal, it does not mean you cannot trade it. Actually, we are seeing more and more of these transactions being traded in the market, which is a positive element for everyone, for our investors and for us. Do we want this to be a liquid market? Frankly, no. The moment you have something liquid, all the elements of market dislocations, of a more efficient situation disappear. Therefore, it means the return for our investor will go away. And the beta and the Vitality's bond that I mentioned earlier are a perfect example. They're very efficient, they're public, they're liquid, therefore they pay level plus 200. I mean, truly, the moment, you have returns only if you find situational inefficiencies in the market, niches area where our skills play at their best. So at the end of the day, frankly, I do not want a liquid market. At least I don't want a completely liquid public market as a whole. Of course, I would enjoy trading and some more public bonds being done in the sector, but I don't think that would change our focus on truly uncorrelated, truly private, and therefore alpha type returns for our investors.
Great, thank you, Luca. Tom, back to you. What's the general duration of transactions in the life ILS market, and also around deal size? Is there a minimum point at which these become economical?
Two interesting questions, and so duration of transactions, 5, 7. You've seen some very long dated transactions. But 5 to 7 seems to be where we like to play, and that kind of also plays in with the way our funds are structured. As far as deal size is concerned, I mean, as clearly listeners and viewers have gathered, a lot of time and effort goes into putting deals together. And so therefore, you want to get a reward for that effort. And so, you're not going to do months of structuring a negotiation for something that is maybe a $10 million investment. So, we try to play around about a $30 million area and upwards. I mean, that doesn't mean that we play smaller. I mean, it kind of depends on the circumstances, and when we can sort of get to understand the counterparty, get to understand the risk, get to understand what it is we're trying to solve for, and then come to an agreement as to what the overall investment is going to be. We'd like that input in understanding the situation, understanding the risks, understanding the structure, designing the right structure, to be worthwhile for us and for our investors, in the sense that we have a pot of money which we're looking to invest in the right opportunities, and so if you do 20 times 10, well, then you get to 200. But if you do bigger deals, fewer of them, you can be more efficient. Of course, all of that needs to fit within your overall portfolio allocation and so on and so forth. So you don't want to be too big a deal, because if it goes wrong, that could have an impact as well. So these are the sort of trade-offs that we have to constantly think about when we are looking at opportunities.
Great, thank you, Tom. So, Luca, as this is a conference designed for the Asia marketplace, obviously Life ILS is not an enormous market in Asia. Can you talk us through sort of what activity you have ever seen, whether you expect there to be traction in the Asia region, both on the cedant and the investor side?
So I definitely see Asia being a key investor base for us. It's already actually at the moment a key investor base for us. And look, that's clear. I mean, it's well known to the industry that the Asian investor base is central for the ILS community. I'm not saying anything new there. From the cedant standpoint, the picture is slightly more complicated. I have worked on opportunities in Asia for a long time. Reality is that I turned down most of them, if not all of them actually, because we didn't think the risk reward was appropriate for our funds. There was a mix of return being too low. There was a challenge coming from the risk not being well priced. In the past, it seemed to me that the Asian insurance community was enjoying a lot of capital being around, therefore returns not reflecting the risk in those deals. So we have turned away actually pretty much all the transactions we have seen from Asia over the last few years. Worth mentioning, though, that in the last 2-3 months, I have seen transactions coming through from Asia, and they're starting to look much more in line with our risk-reward will. So I would expect Asia to become more and more relevant in the global picture of Life ILS in the near future. And certainly I hope so. I mean, if you think about where the growth can come from in terms of cedants, Asia should be there. And the last sign, as I mentioned, are there that Asia will be there in the near future.
Yes, and in one of the sessions at the start of this event, we had a presentation where they talked through sort of the growth of insurance penetration, and actually Asia Pacific is growing incredibly fast on the life side at the moment. So I assume the values at risk in terms of portfolio sizes are going to be growing quickly in Asia, which should result in some need for risk transfer and financing. Tom, is Asia a focus for you guys, or are you in pretty much the same position that it's an area you look at but don't find the attractive opportunities quite yet?
That's right. I mean, we look at it, the opportunity needs to be right, the economics need to be right, and then, also importantly, as a framework, right, can we get comfortable with, some of the additional risks that we don't really have to worry about when we do business in Europe or the United States? Do we really understand the regulatory regime? Has it been truly tested for some of the things that we're trying to achieve? And that aspect is also quite important, in addition to some of the points that Luca mentioned. And we've not been able to sort of come to a landing on finding that right opportunity, which hits all of these boxes, so that we can make that investment, make that effort, spend the time truly understanding the environment, the regime, the regulatory regime that is, to go and invest. But we would welcome it from a diversification point of view.
Sure, absolutely. So we've got another question here. So from a cedant point of view, the no loss argument, which appears prevalent in life ILS to a degree, looks more of a reason not to use an ILS solution sometimes. You'd like to get paid, obviously, when losses do occur. So how do you think this will play out over time if cedants aren't able to collect on covers? I'll throw that open to either of you, whoever would like to answer. Okay, maybe I'll direct it to Luca then.
Look, I'm not sure actually I understand the question in its entirety. Look, let me take a step back actually. And let me go back to the building blocks, what we do. There are two areas. One is pure risk-driven, capital-driven, etc., which is the one of the risking opportunities linked to Solvency II, linked to rating, etc., etc. And there we get paid because of two. One is risk by definition, and one is the customization to our counterparty. So there are two different beneficiaries of the work we do here. One is the cedant. They on one side has the right regulatory framework around it, the right solution that fits their rating, their capital, their risking needs, etc. As such, they can afford to pay more. And on the other side, you have the investor that has a fully decorrelated investment, as we discussed many times, and enjoys a higher return than the risk should suggest because of that complexity. So it's a win-win for cedant and for investors. If you move to the funding side, you start going down a little bit on the side of the counterparty. I mean, the solvency solution we discussed, the risking solutions, tend to focus on the the larger counterparty side, therefore the blue chips, etc., etc. When you talk about financing, of course, you try to target the mid-tier sector, second-tier insurance companies, smaller ones, etc., etc. In that case, the benefit for our counterparty, i.e. the insurers, is the fact that we can construct a financing structure that meets their needs. Something that meets their cash flow needs, something that meets their regulatory or rating needs. And that's the main benefit they see from the perspective, i.e. something which gives them a highly efficient, from a capital standpoint, from a rating standpoint, from a cash flow standpoint structure. And that translates again in terms of transaction into a structure that our investor will enjoy because of the higher return compared to the risk. Are there no loss structures? They're not. By definition, we're here to take risks in the life and health space. The point is, and I would like this to become clearer and clearer for investors, is that we do not get paid by taking a risk. We do get paid by taking a risk in such a way that we solve complexity, we solve difficult situation, and we get paid much more than we should for that risk. Hopefully that answers the questions.
Thank you, Luca. Thank you. So, Tom, over to you. How long can investors expect to have their dollars allocated to life transactions? And I guess how do the funds work? Are they fairly typical with other life ILS funds in terms of lock-in periods and the ability to liquidate or get money out again?
So we run a variety of strategies, and some of them are closed-end, some of them are open-ended. It really truly depends, and we're constantly thinking about new structures. I mean, from our point of view, in order to find the right opportunities, it's to some extent more efficient to have an investment period and then a lock period where we just harvest, because then we can constantly go and find new attractive investment opportunities and move on, rather than worry about potentially money being repaid and so on and so forth. So there is no real typical way in which we do it, given the breadth of investor solutions we have available.
Okay, great. And is there any sort of shortage of capital, do you feel, for I mean, obviously, as an investment manager, you can always do with more money from investors, but would you find the demand if you did raise a significant amount more capital, or is there a sort of an equilibrium at the moment that you can grow at the pace that the market grows?
I think
or demand for the product?
I think more can be done. I mean, we sometimes have to turn opportunities down. We could find attractive opportunities. As we do something, we get smart about a specific problem. Then once you have all of that knowledge base, you can try and find someone else who may have a similar problem and go and apply it there. And when you do that methodically, hopefully you can just keep on finding attractive opportunities, whilst at the same time making sure that you're not sort of honing in on just one type of risk and balancing all of that out. But you seem to be able to do that, and we'd love to do more.
Great, thank you, Tom. And Luca, in a similar vein, the life ILS market is really quite niche. There's only sort of 4 or so managers who actually manage life ILS funds and life risk in any sort of significant way. Why do you feel it isn't more diverse? Why do you feel there isn't more choice available? And do you see this perhaps changing in future?
It's a very fair question, Steve. Thank you for that. I answer to your question, Steve, with 2 numbers. One is the number of sessions we have and how many of those translate into a deal. The second one is how long it takes for a deal to actually happen. And starting with the first, out of 100 conversations we have, probably one of those becomes a deal. All the rest, all the 99% of them, fail because of correlation, i.e. the lack of the correct profile, as we discussed, fail because the counterparty is not happy to pay the return we require, or fail because the counterparty has found a cheaper alternative in the market. Going to the second element, timing. To give you an idea, I mentioned a transaction we did in December 19 last year, an innovative longevity deal. That took me 2 years to get it done, between the first conversation and the closing. We closed another innovative commission financing deal 2 weeks ago. And again, I started working on that specific deal in October 18. So all this to say that the engine of our business, if we want to deliver those attractive returns and keep a truly decorrelated profile, is origination. Origination is the engine of our business, because we need to be able to find those extremely attractive, extremely decorrelated opportunities. And this is, going to your question, Steve, a massive barrier to entry for competitors. Because you need the origination skills to find these opportunities that are difficult to find. You need also the analytical structuring skills to be able to find a suitable solution for our investor base, for our cedant, and something, again, that scopes out all the non-core biometrical risk we want. So do I see more and more funds to slowly come in? Absolutely. The question, I guess, to ask is how many of them will actually succeed in doing that? Because I know that many are trying. But the barriers to actually have this business something successful are high. So I would expect most of them to fail. Some of them will, of course, succeed, and they're more than welcome to join our business, of course. But it is not a walk in the park, let me tell you that.
Sure. Absolutely. So one quick question before we begin to wrap up. Obviously, technology advancements are continuing apace at the moment. We're seeing much more health and life-related data now available, much more granular data, and then we have the advent of sort of wearable technology and all of the biometric information that can provide. Is this an area that you explore and you're looking at, and do you think there might be transactions that appear in future that are more based on this data as the source of sort of trigger information, perhaps? Let's go to Tom first.
Yes, I mean, it's something we look at, it's something we think about, and clearly the way we invest is somewhat data-driven, right? I mean, we analyze behaviors, whether it's mortality behaviors, lab behaviors, so on and so forth. And so, the more granular data you have about an individual and how he goes about his health, how he goes about his lifestyle, may give firms very interesting opportunities to write business. That granularity is something we can use to make more interesting and more efficient transactions. And then I spoke earlier about the sort of broader ecosystem of life and health. There are players that sort of are around in some of the steps in between the consumer and the carrier, and so that's an area we look at, and we see some interesting. We've had some interesting discussions with people in that space because, clearly, whilst there is an interesting and attractive opportunity set out there, in order to continue to differentiate, in order to continue to capture, the risk spread that you require to capture, you have to ensure that, you're always looking for the new, well, the new thing is probably the wrong word, but for an attractive opportunity that fits within the mandate and the scope of what it is you're doing. And as long as you can find something that is truly biometric, related to life and health insurance, we're definitely pursuing that.
Great, thank you, Tom. And Luca, is that the same for you? Is technology an area you are keeping up to date with all of the startups in that space? Absolutely.
So there are two different sides of the same story. One is the data element you mentioned. I mean, the analytics part of our business is core. I mean, I described earlier the origination structuring element to it, but analytics is equally important because we want to be able to analyze every single deal with internal data or with an internal approach. Because as probably our investors know, standard models for life ILS, unlike on the non-life, we have various modeling firms. So the capabilities around data modeling is core to our industry and will always be the case. Second, the other side of the coin is that we are engaging more and more with insurtech, with new companies that are thriving on their ability of analyzing and sourcing those data. Because it means that the writing is better, it means that we can offer them a better deal as a result of their better underwriting. And as we all know, it's a sector that has fantastic growth prospects. So we expect more and more to come from those type of players.
Great. Thanks, Luca. Okay, so I think we've really run over our time slightly this morning. So I think it would be nice to just finish with a brief wrap up from each of you on what's your outlook for Life ILS over the next year. Let's start with Tom.
I think it's going to be busy. So on the one hand, we hope there will be some demand for extreme mortality in the wake of the current pandemic, as people are sort of thinking more about buying protection against something that they found themselves confronted with earlier in the year. Secondly, again, as traditional capital is probably standing a little more towards the sidelines, we hope to continue to be able to find these attractive opportunities that we have been talking about throughout today's session. So I expect the next 18 months to be busy and hopefully strong for our sector.
And Luca?
I'm very optimistic about the future Life ILS. As I told you actually in the past, Steve, my personal motto is making the difference to our counterparties and to our investors. And the current context where capital is becoming more expensive for insurance companies and reinsurers, current context where people, as we discussed earlier actually, are more aware of what life risk actually means, I would expect on one side more demand for cover risks across mortality, across health risks, across lapse as well. And on the other side, the ability to charge more for the same type of risk, because people will be willing to pay more for the risk that they consider theoretical until a few months ago, and now they consider something more real. So our investor will benefit from both a size standpoint and also point.
Great. Thank you, Luca. Thank you, Luca. Thank you, Tom, as well. And thank you to everyone who tuned in. I hope you enjoyed that discussion. Certainly something for everybody to learn about the Life ILS space, and hopefully it's interested some of our viewers in Asia who perhaps aren't so experienced in this segment of ILS. Thank you, gentlemen. So we'll be back in a few hours with a keynote presentation and also Q&A session with Tom Johansmeyer, head of PCS. That's at 1 p.m. UK time, which is 8 p.m. Singapore, 9 a.m. Bermuda. You can still register for that if you have been registering individually for the sessions. So thank you again, gentlemen. I appreciate you being involved in this discussion today, and thank you to our viewers.
Thank you.
Thank you.